The Korea Exchange announced a Value Up Index last week, selecting 100 best practice firms in efforts to revitalize a stagnated local stock market. It's designed to address the so-called Korea discount and improve corporate governance and shareholder returns, but the list has quickly become a source of controversy, with critics arguing that the stock selections undermine the program's intended goals. So on today's GMS Focus, we examine the newly announced index, its surrounding controversies, and the key elements then for its success. For this, we now connect with our regular commentator, Professor Yang Jun-seok, economics professor at the Catholic University of Korea. Good morning, Professor Yang.
Good morning.
It's apparently International Coffee Day. Happy International Coffee Day. Thank you for joining us. Let's get started. First, maybe you can help both myself and our listeners understand more in detail about the newly unveiled Value Up Index. Which companies made it to the list, and what criteria specifically were used for the selection?
Okay, well, let's start with the Korea discount. Korean stock investors and companies have long complained about it. It's when the stock valuation and stock prices of Korean companies are lower than the comparable foreign companies. And in addition, the government lately has been emphasizing that Korean companies' stock prices are low compared to their book value, or the PBR, stock price book value ratio, is lower for Korean companies than for similar foreign companies. Now, Value Up Index was supposed to supply guidelines that firms could follow to reduce or eliminate the Korean discount and introduce firms which do very well in this index so they could lead the way in eliminating the Korea discount, and investors can easily find firms that it does not have or have very little Korean discount to invest in. But the variables that Korea Exchange used to calculate the index, well, the selection of those variables turned out to be questionable, and the way that Korean Exchange chose the best 100 firms in the index was also questionable. So let's look at the variables behind the index. Now, the index consists of 5 categories: market representativeness, mostly size. It has to be among the top 400 companies in terms of stock valuation, and then they differentiate according to different industries. Second is profitability. The firm cannot have any losses for the last 2 years. The third is returns to investors. Here they look at dividends and whether firms engaged in stock buybacks to keep the stock prices high. The fourth is market valuation. Mostly the variable used here is the PBR, the price book value ratio. And the fifth, the last, is efficiency of capital. That was measured mostly by returns to equity, or ROE. But these variables do not seem to deal with the core causes of the Korean discount, and they may emphasize the wrong things. So it's been meeting a lot of criticism. And if you look at these criticisms one at a time, then for the first category, the market representativeness, as I mentioned, it only looks at firms which are already large, already successful, and so there's no small or medium-sized businesses, and there's no real hidden gems that were found. And then the second, profitability, well, this doesn't hurt, but doesn't really help either. That's because when investing, you want to look at profitability of the companies to begin with. These firms are not going to be undervalued to begin with because they do have high profitability. And then returns to investors, this may be the most problematic. It's measured most by whether the company gives dividends and whether they did stock buybacks. I'll talk about dividends later, but I think dividends are wrong criteria to use, but I do need a lot of time to explain it. So I will explain that part later on. But stock buybacks raise stock prices by companies buying back their stock and reducing the supply of stock in the market. The United States, during the corona pandemic, they handed out a lot of money to companies to maintain employment, to keep on operating, and the companies used that money for stock buybacks, and that gave a lot of criticism about the company's use of money for stock buybacks. And that's because stock buybacks really don't do much to raise companies' productivity. It doesn't improve the company's technology. It just buys back the stock. So other than making stock, perhaps stock prices, keeping it artificially high, it doesn't really do anything for the company, but uses up the company's money. Now then, let's look at the fourth criteria, the market valuation that looks at PBR, as I said, and it kind of seems like a paradox. You're supposed to find companies which are undervalued, and in this case, it here means that it doesn't. It's not supposed. You're looking at companies which are perhaps undervalued because of Korea discount, but by selecting companies which only have high price to book value to begin with, you're looking at companies which don't have any Korea discount, so this will help companies which do not have the discount, but you're not really finding any companies which are undervalued. And then the last category, the efficiency of capital, it's mostly measured by returns to equity, but this is return to equity, or ROE, that is you have to use that criteria very carefully, because while it can mean how efficient a company is, higher ROE means that you're earning more money using perhaps smaller amount of capital. What it does sometimes encourage you to do is, well, if you have higher capital and you're making the same profit, your ROE comes low. So you want to reduce your capital, but try to make the same profit. So what a lot of companies do is they borrow, and sometimes they can borrow recklessly. Unless you have a supplementary variable backing this up, you may actually be encouraging firms to borrow money. And of course, large corporate debt is one of the problems that Korean companies have. And it may be one of the reasons why there's a Korea discount. So they really, I think, have chosen some problematic variables to measure the Korea discount. Now, I said that I'll talk about dividends later, and I think the dividends can give you an idea of the core part of the problem here. Let's say that the dividends are given by companies when they make profits. Part of that, if the part of the profits the company's board decides to give back to their stockholders, that's the dividend. But companies can either give dividends and lower the cash holdings, or they can keep the dividends and keep their cash high. When this happens, in the textbook economics, what's supposed to happen is that if you keep the money inside the company, your book value goes up because your assets are higher because you have that cash, and that should be reflected in the stock prices. So from the investor's point of view, if company makes profits, you can get that money back in cash through dividends, but stock prices are not going to be high as it would have. Or you can company can keep the money in the company, and because their assets go up, their book value goes up, and stock prices will go up as well. So either way, the investors not really hurt. Now, the only way that this doesn't work out like textbook economics is that if the market is not confident that the cash will add value to the company in the future. Now, usually the cash that's left over in the company that's used to make new investments, and if those new investments are very successful, then that will add profitability of the company to the future. So if you use the money not for dividends but for investment inside the company, that can make book value higher and stock value higher in the long run. But if that doesn't happen, in fact, if the book value turns out to be lower, the value of the cash that they do not hand out for dividends, it's not reflected in the book value, or it's reflected very little. It's not reflected fully. That means that you don't really have a confidence in the management that they will use this money wisely. That seems to indicate that market feels that the management will waste this money somehow, and perhaps that's what the Korea discount shows in large part. They just do not have the confidence that management will use the cash wisely, in which case it's better to have that cash back now through dividends than let the company keep it. So in that case, you're really the lack of dividends and Korea discount is really showing that the companies are not really, or market is not really confident in the market's management. Now, Korean companies tend to hoard cash, and stock holders, as I said, may be concerned that this cash will not be used to expand the company or make profitable investment and increase the value of the company, but rather to make bad investments or worse, use for the management's private use. So if you don't have confidence in the management, if you don't have confidence in the long-term value of the company, then not only will you complain about not getting dividends, but also you tend to make short-term investments rather than long-term investments. So you'd rather buy the stock, wait until the price goes up and sell it quickly rather than hold on to it for 10, 20, 30 years, confident that the value of the stock will increase. And that tends to be what's happening in the Korean stock market. The Korean investors in stocks tend to be short-term compared to other countries and more risk-loving, more risky investments than other comparable countries. So this lack of confidence behind the value-up ratio seems to have been worsened by the haphazard way that Korea Exchange seems to have chosen the top 100 firms. It seems that the average growth rate of average growth rate of profit for the top 100 companies that were selected are lower than the overall average growth rate of profits for stock market in general. And other analysts point out that many of the firms in the index are currently considered overpriced rather than underpriced. So basically the market and the market observers were really disappointed in the value up index.
So a day after the Value Up Index was announced, individual investors reportedly saw losses in 75 out of the 100 companies listed by the Korea Exchange. How are things looking now? Did it bounce back? And what have been the latest market reactions?
Okay, well, on the first day, the Value Up Index of the 100 firms did lose 2.8% in value, but in the first 3 days, it made up the lost value and gained 2.1%. And at least according to the Korea Exchange, it outperformed Kospi 200 index, the 200 largest firms in Kospi, and Kospi index overall, which only grew by 0.9% compared to 2.8% for Value Up Index. But overall, it does seem that the markets may be shrugging off the Value Up Index. Note that the profitability is one of the criteria of the index. So at least on paper, any firms which take a loss will be excluded. So the firms in the Value Up Index should have higher returns than the wider Kospi Index, which may include firms losing money. So in some sense, the Value Up Index having a higher growth rate or a higher gain in value rather than the overall KOSPI index seems to be something that's built into the index, but still, the market seems to be shrugging the value up index off. Whether the value up index was really profitable or not, whether they have truly have undervalued and have potential to grow more. Well, basically, we need more data and analysis. It's been less than a week, and there's not going to be enough data to do a formal analysis for at least a few months or maybe even a year or so.
All right, so waiting on more data collection to more accurately get an analysis of this. But for the time being, maybe we can examine the surrounding controversies closely. Tech and industrial names dominated the 100 list. Critics argue many undervalued high dividend stocks were excluded, while stocks with low dividend yields and limited shareholder returns were included. So could you elaborate on this and also maybe highlight other key points of contention at this point in time?
Okay, well, the top 100 firms does seem to be chosen a bit inconsistently. For example, KDB Financial Group and Hana Financial Group, the two of the five biggest financial groups in the country, they are known to have very good relationship with investors. They are known to have very good measures for stockholders and were widely expected to be one of the top 100 firms or two of the top 100 firms, and they didn't make the cut. On the other hand, the SK Hynix, which did not have the highest scores and it lost money, did make the cut. And the Korea Exchange said that was because of their industrial representativeness. The index didn't find any diamond in the rough, that is, firms which have high potential to grow, even though they did have problems with the Korea discount. And if you look at the variables that were used to calculate the index, a lot of people, including myself, do not feel that these variables offer a good guideline for other companies to endeavor to reduce the Korea discount. In fact, by including the PBR as the only category for value, it actually picks out the firms which do not have any problems with Korea discount without showing why these firms do not have any problems with Korea discount. So there's really nothing for, say, firms outside the top 100 to aim for because, well, they don't have any variables which can potentially improve their position by showing how Korea discount can be reduced. Now, as I mentioned before, the key reason for Korea discount seemed to be corporate management and corporate governance issues, including mistrust of management, and other reasons often cited for Korea discount are tough and inconsistent laws and regulations which affect corporate cost and profitability, the North Korean threat, the high corporate tax rates, and general pessimism about the Korean economy. But index doesn't really have any variables which deal with these factors directly. And the Wall Street Journal has reported that the Korean market, as well as foreign investors, were disappointed in the value index, but further offered that with Korea's Chabar management structure, effectiveness of any value up index would be limited due to the management structure, which emphasizes the founders' families. And because for Chabar families, it actually pays off to have lower stock prices, because when they have to change owners to give the stocks to their sons and daughters, if the stocks are very expensive, then they may have to pay high taxes, or if they have to buy additional stock on the market to hand over to their children, it's going to cost them more. So the index does very little to deal with these corporate governance problems. So I think that was one of the reasons why the market was so disappointed in the value up index.
Professor Yang, it might just be early for us to just create the perfect solution to how to better tackle it. But what would be the key successful implementation of the value up program to address the very reason why it was created, counter Korea discount?
Okay, well, I think you need more variables on corporate governance.
Okay.
If the core reason is really the lack of confidence in the Korean management, then you need to select companies which have a good relationship with their stockholders and have lots of mechanisms where investors can find out things about the company and make good investment decisions. So if I were making the value up index, I would add these corporate governance variables, whether the management has very effective communications with investors, whether the management gives what their vision of the company is to investors. Do they have any checks and balances so that if the management, say, makes bad decisions, then stockholders can rein the management in? Do they have transparency variables about the state of the company? Do they have good information standards, including accounting standards? I would add those type of corporate variance, corporate governance variables, and market representativeness category should be rethought so that well-run but smaller companies can be included. And as with any good index, say something like the International Competitiveness Index, the information and variables underlying the index should be made widely available and accessible. Now, these variables that Korea Exchange used to calculate the index, they are publicly available variables, but sometimes you have to dig pretty deep to find it. So if they were really serious about the value up index, then they should have all this information easily available, say, on one single website, not only for the top 100 companies, but companies which fail to make the cut. And perhaps not limited to the top 100 companies, but include even more than 100 companies if they make, say, higher than 80 points on their rating scale.
Thank you so much, Professor Yang, for your insights. We appreciate it. We'll speak to you again next week.
Thank you.
If you're listening to our program using the podcast service, just a reminder that we do go live Monday through Friday, 7 a.m. Korea Standard Time. So tune in and help us make the show more informative by giving us your input. See you bright and early on Good Morning Seoul.